All right, we're just about half an hour away from the opening bells. Hong Kong, Shanghai, and Shenzhen. You're watching the China Show. I'm David Ingles with Yvonne.
Our top stories this morning: Asian stocks decline with bonds under pressure after hotter than expected U.S. inflation data. The yen plunge, prompting a verbal warning from Japan's currency chief.
China set to report, and speaking of inflation, March inflation comes out this hour with consumer and producer prices expected to show further deflationary signals.
And Chinese state media slamming the U.S., Japan, and the Philippines as their leaders prepare to meet in Washington. Yep, you could say there's some declines when it comes to equities, but a stronger word we see what fixed income is doing right now. Basically, Asia bonds are getting a bit slammed after waking up to that US CPI print that came out hotter than expected, and a third straight print where we have seen better than expected numbers coming through when it comes to US inflation. So you're seeing a lot of the short end of the curves really getting roiled here. The Aussie 5-year yield is up some close to 14 basis points. The 10-year JGB is at the highest we've seen since around November. So certainly there is that sense that, we can probably say goodbye to that June rate cut right now. That's at least what the Fed pricing is changing in the moment. The narrative seems to suggest maybe September could be the time when the Fed starts cutting. So certainly that has led to risk assets to be on offer here today. You're still seeing a decent upside, or at least holding on to the gains when it comes to oil prices. Obviously, there's been some, our sources saying there's some potential risk here of Iran doing something. So we're watching very closely crude markets. Shanghai crude is also up by about 1%. It's an ECB decision as well, and we continue to watch. The question of the day: are we going to see parity for euro dollar? Just given the fact that if the Fed's not going to cut anytime soon, ECB seems more inclined to do so, maybe potentially as early as June. 107.42, a pretty decent drop in the euro overnight as well. Dollar yen, we talked about briefly touching 153. We're at 152.85 territory here right now. We just heard from those condo lines and talking a little bit more about how they're not ruling out any options right now. But certainly, just given the volatility, we have some sort of indications here. Bloomberg's crunching the numbers. This Conda index we'll show you about a little bit later on. Perhaps the volatility is not enough at this moment for Beijing, I should say Japan, to step in. Take a look at how U.S. futures are. We're still on the back foot there. Dollar is still catching a bid here this morning. You take a look at what's going on in treasuries, and basically the entire treasury yield curve is once again higher. And we're talking about close to 5% for your 2-year yield here right now. 4.55 for the U.S. 10-year yield. That's the first time we've broken that level since November. So we continue to see the short end of the curve at least stabilize here in the Asia session, but we continue to see interesting moves in the 5-year as well. I think at one point the 5-year yield was higher than the 30-year yield briefly overnight as well. You take a look at how the China setup is. Okay, so we got through the U.S. CPI print. We're still digesting that. Chinese inflation could be potentially quite interesting as well, right? So if we see some more signs of maybe a positive print for a second month in a row, is this a sign that maybe deflationary pressures are abating? That's a key question there. A50 futures are still on the back foot. Looks like it's still going to be a risk-off day throughout the region here. 229 for your Chinese 10-year yield and a 726 handle for dollar China. Hang Seng futures does show that too as well. Keep in mind also the renminbi against the yen is at multi-decade highs right now. So there is still, some say, that competitive devaluation risk going on there when it comes to some of these currencies here in the region. Hang Seng futures are doing this. So it looks still, the last 2 days though, it looks still elevated, but we could be seeing a pretty decent drop here today, Dave.
Yeah, that rise and fall, the rise was yesterday, and the fall about when that inflation print came out. And really, you could almost draw a line and turn that page in markets. You really see when the inflation print dropped. In fact, just in the Japanese currency, to build on Yvonne's point, right? Yuan against the yen, we haven't seen these levels going back to the early 90s. The language coming out of Japan and the chief currency name to watch, of course, Mr. Kanda, coming out with fairly stronger, not quite extreme just yet, but fairly stronger language as it pertains to how they're describing some of these moves. Rapid, significant, and decreasing in terms of the benefits of a weaker currency. We're watching that very closely today. Apart from that, Chinese inflation coming through. We are, as we've been in the last few days or so, in the window for credit numbers coming out of China. Speaking of declines across these markets, CSI 300 is already on the longest losing streak going back to early Feb. Day 6 would actually take that streak back to August 2023 levels. China-Taiwan ties in, of course, this massive crash, by the way, in the cement stock trend rate. That stock crash yesterday, we'll see what happens with that. And a reversal lower we were talking about is on Hang Seng Index. Probably gives up most, if not all, of the gains coming out on Wednesday. I forget what day of the week it is, but yeah.
It's Thursday today. It's been a long week, though. Yeah. You've been covering HSBC.
You have too, though.
Yeah.
Yeah.
And then we had New Voices, which I'll tell you about a little bit later on.
Yeah.
But certainly, you
Wink.
talk about that inflation print. I mean, across the board, it was pretty strong. Particularly when it comes to the core CPI, 0.4% month on month. And really, we talked about how beating expectations for a third straight month. You had the likes of Goldman pushing back their forecast now for a cut to July. Barclays only talking about maybe one cut this year. And then, of course, you have the Larry Summers commentary saying, look, maybe we need to talk about a move upwards for rates versus the other way around.
Okay, yeah, let's hear from some of those guests earlier on.
Inflation is just becoming a very stubborn situation for the Fed.
This is too much for the Fed.
Inflation's not doing what they wanted on average, and this is a problem for them.
The sound that you heard there was the door slamming on a June rate cut. That's gone.
I do think it shuts the door on a June rate cut.
The Fed is not, in our opinion, is not going to be making any moves anytime soon.
They're more likely to hold status quo.
Pretty good reason for them to remain on hold here, see how things go.
A rate cut in June, it seems to me, would be a dangerous and egregious error.
At the moment, I think they'd probably set up for September and December, 2 rate cuts this year.
There's a real risk of no rate cuts. That's starting to come into the narrative, and I think that's new.
They're, creating a problem for themselves in terms of the promises of rate cuts, the inability to actually execute on them.
Bill Maldonado is with us, CEO and interim CIO at Eastspring Investments Group. Bill, a pleasure to have you on the show. It's been a while. You've traded periods of sticky inflation in the past, Bill. Remind us how to trade this part of the cycle. What would you do this time around?
I think the key question for investors here is the strength of the economy. Because we've been, the market's been very, very focused on the Fed action, on rate cuts. We've seen inflation moderating, particularly on the goods side, a lot more sticky on the services side. I think the number to watch now is the labor inflation number. I think that will be the main thing that will allow the Fed to ease, if they are going to ease a bit later this year. But the economy remains strong, and that's probably good news for investors in risk assets. US equities are not that expensive, ex the sort of Magnificent Seven stocks that have been flying high over the last 3-4 months or so. The broader market is not that stretched. High yield still looks like it's got good value to offer. And if we look internationally, there's even more opportunities if we're going to see that growth persisting in emerging markets and across Asia. So I think there's a lot of interesting things to play, even if the Fed rate cuts are going to be a bit slower in coming.
Slower in coming. So you still think they're going to come this year, Bill? If Fed pricing is right, September, that gets very close to a November election. Will we see a rate cutting cycle at all?
Yeah, it's an open question, Yvonne, I would say. It is possible. I think there is a material probability that we're heading for a soft landing, no landing scenario. And then maybe rates stay where they are. The other thing I think that investors need to consider, and which needs to come into the conversation, is the Fed balance sheet. We saw a lot of QE measures during COVID, even lasting post-COVID. And I think the central bank is still running a balance sheet that's a lot larger than it needs to be under normal conditions. So what's the play there? We've been very, very focused on the level of rates, but the bank is running an enlarged balance sheet, which is in itself stimulative.
Right, and that takes us also into this relative value conversation, if you could call it that, between fixed income and equities, Bill. And how do you look at the bond markets right now with effectively 5% yields on the Treasury curve?
Yeah, so look, I think that corporates, particularly in the US, the high-grade corporates are a bit stretched. Spreads are very, very tight there, and there's not a lot of wiggle room. But if you look a bit further than that, as I said, high yield in the US, and then if you come across to Asia, both the investment grade and high yield, I think, offer very interesting opportunities. Yields are pretty high. There's no real fundamental reason for that to be the case. We're not expecting, for example, default rates to increase materially in Asia. We're not expecting any big surprises in terms of inflation or central bank action across Asia. So I think there's great opportunities there. And as you both know very well, we've got the Indian bond market coming into focus increasingly with the addition into the benchmark indices, and that's a new area for a lot of investors. So there's a lot to play for. There's a lot to do if you look a bit further afield.
That's right. I was just talking to HSBC Asset Management yesterday, and they're expecting, I think, $100 billion of flows into that market in India, Bill. I was going to talk to you more about your talk about the Asia credit space and the opportunities maybe in bond markets there. Are you adding duration in this area right now?
I think selectively our fixed income teams are doing that, and I think you can afford in this environment to be patient and to wait for opportunities, to wait for blips, maybe like the one we're going to have now and today. So I don't think there's any big rush to do that. But yes, I think selectively that's something that our teams are looking to do.
Bill, the temptation to go back into cash, just your thoughts and your advice around that.
Well, that's been one of the sort of main plays that investors have had. There's a lot of cash sitting on the sidelines. You know, when you can get 4.5% to 5.5% on your dollar deposits, if you go out, you know, 3, 4, 5 months, that's very tempting for a lot of investors, particularly in such an uncertain environment. But that cash that's sitting there is also the dry powder, the kindling that might get markets going rather well. And particularly in China, we saw bank deposits hit all-time highs about this time last year, and they've stayed more or less there. So there's a lot of dry powder if and when the growth dynamic comes back into play, and people look more towards that than worrying about the slowdown and worrying about what's going to happen when the Fed has to cut rates.
Bill, you mentioned at the top the focus has been too much on the Fed, and we need to look at the economy. Let me use that prism and look at the Chinese market and the valuations on offer in this greater Chinese equity market and the state of the economy and also the policy push that's taking place there. Are you getting a sense that people are warming up to more exposure to this Chinese equity market, Bill?
Yeah, David, that's a great point. I think that certainly in terms of sentiment, the negative sentiment that we've had towards the Chinese economy from international investors, that seems to be bottoming out. I think that investors are now beginning to look at China a little bit more objectively, with a little bit more of a positive slant. And I think there are many opportunities. We see growth edging up. We see quite strong earnings being delivered by a lot of companies in China, and we see very, very cheap valuations across many sectors. So there are a lot of opportunities. Again, once investors decide to come back into the fray in China, I think we could see some quite interesting moves.
Bill, hold that thought one more from Bill Maldonado there from Eastspring Investments Group. He's staying with us. Coming up, we're set to get some inflation data out of China next. Those figures in just about, 16 minutes or so. Could we see a retreat from March? That certainly is one story we're tracking. We'll bring you that data shortly.
Okay, so the reference rate for today is out, and this is actually the strongest on record relative to estimates. So we're getting a spread here and unsurprisingly so, given the strong dollar that's come through in the last, 12 or so hours, north of 1,500 pips. In fact, nearer 1,600 pips stronger than the estimates out there. So a little bit of anchoring coming through as well. And unsurprising, again, so given the strength in the U.S. dollar.
Yeah, I mean, certainly we need to see signs of that support. We're certainly seeing that verbally in the Japanese markets and here today with what we heard from Kanda-san this morning. We're back with Bill Maldonado, CEO and interim CIO at Eastspring Investments Group. The asset managers, funds under management and advice rose 7% on year back last year to more than $237 billion. Bill, before we get to the business side of things, you mentioned in the last block about how investors are getting more objective when it comes to looking at China. What sort of exposure do you have in the mainland here right now? And does the nature of this market, has it changed in your view?
So we've been on the more positive side of the sentiment for quite a while now. We think there are a number of sectors which are very robust in this environment. There's a lot of sectors which China needs to invest in, has to invest in, from clean tech, green tech, battery technology, EVs, semiconductors, and there have been opportunities in those sectors all of this time. As we mentioned in the earlier segment, I think sentiment is kind of bottoming out. 6-12 months ago, it was kind of hard to have a discussion with investors, international investors, about China, their exposure to China, the opportunities there. It's now become much easier to do that. People want to have that discussion. I think that's the precursor to seeing more money being deployed in China. So I think we remain very positive. We remain exposed, and I think there are great opportunities there.
And Bill, simply from a strategy or a mandate perspective, and not that this would indicate sort of views on the Chinese market, but some of your peers have started ex-China strategies and funds. Does that make commercial sense in your view?
It does, and we were one of the first firms actually to establish an ex-China benchmark. But I think we need to be a bit careful as to how we interpret those moves. It doesn't mean that people will do allocations to emerging markets or to Asia by completely removing China. What it means is that they sometimes want to appoint different managers for their GEM or Asia portfolios and for their China portfolios. And they maybe want to have a more dynamic allocation to China. So I don't think that in itself is a negative signal on China. It's an interesting development in the way that people allocate to those benchmarks.
Can you tell us a bit more about the business onshore? What are your plans there this year, Bill?
So we've got a really great JV there with our partners, with CITIC. We're expecting that to pick up this year, along with the rest of the market, with the rest of the industry. We're quite excited about the possibility for growth there. As we mentioned earlier, there's a lot of cash sitting on the sidelines. Domestic Chinese investors have been sitting on that cash for quite a while now. There's signs that that's beginning to come back into the market. We see some data on opening of brokerage accounts and mutual fund investors and things like that, which are indicating early signs of that. So I think there's good reasons to be positive. We also have a lot more interest from offshore investors, as I mentioned earlier, and that external money flowing to China could also be a very interesting dynamic. So I think we're exposed to both sides of that trade in the business, and we're relatively constructive.
Bill, just a final thought, just to pivot to India, which has done very, very well, and I'm wondering how that's affected how you're looking at that commercially as well, the Indian market, Bill.
Yeah, look, India is fantastic, and we've got an amazing business there. It's a JV, ICICI Prudential Asset Management. It's the second largest asset manager in India. It saw phenomenal growth last year from about 60 billion to 80 billion AUM in 1 year. That was a combination of the market and of flows. And I think the macro environment looks pretty robust, pretty good in China. Earnings are going to deliver this year likely. The big caps look undervalued. So from a business perspective, that's a really great cocktail that should be able to continue to power investment business in India. And we're very, very positive from an investment perspective as well.
Bill, a pleasure to have you on the show. Thank you for your time. And speaking of time, let's not wait this long before we can have another chat like this. Bill Maldonado, the CEO and interim CIO, Eastspring Investments Group in Singapore for us this morning. Right, just very briefly looking at this open, and we're just, 7 minutes away, but indications are after the fairly strong fix coming out of the PBOC, the equity markets gap lower on the Hang Seng Index. We're looking at 16.8 right now on the index after we briefly topped 17 yesterday. Plenty more ahead. A full preview of the trading day, including the inflation numbers coming through today. This is Bloomberg.
All right, 5 minutes away from that China CPI data coming through here, and we are expecting possibly a bit of a retreat from those bumper numbers we saw in February, which was during that Chinese New Year holiday. So certainly we'll see if that deflationary pressures linger and come through again. Once again, PPI prices, I think we're expecting an 18th month of contraction, Dave.
Yeah, there we go. So quite the contrast there with the inflation numbers, which came through obviously overnight, and that rate differential, that inflation differential, the PE differential, where you are in the cycle differential, market differentials, in fact. Have a look at this. Equity markets going into the open today, 1.7% to the downside. So we just about reversed the gains yesterday on the Hang Seng Index. That lasted quickly, didn't it? Okay, 2% on the HS Tech Index. USD, CNH offshore, we're trading at 725 here against the US dollar. And all that against the backdrop of this inflation, this rat poison that's back in the mix for risk assets right now. Bond stocks down. 3 minutes to the opening bell. This is the China Show.
Welcome back. You're watching the China Show. We're counting down the open of markets, and of course that the China CPI print that could be coming through here any second now, along with PPI prices, and hoping maybe we'll see some sort of maybe a continued, at least in expansion when it comes to CPI prices. But then again, February was a different sort of month, so maybe we might see a bit of retreat there according to Bloomberg Economics, and really we might not see something sustainable in terms of prices until we see a revival of domestic demand.
10 seconds. I'm just looking at my timer right here, so waited with bated breath. I have 5 seconds to tell you that Goldman Sachs and Morgan Stanley upgraded their growth forecasts for China, 5% and 4.8% for Morgan Stanley. That data should be out any second. Now, as with the open, we're still not seeing it at the moment. Declines, though, across the board as we wait for that 1.6% to the downside on the Hang Seng Index. MSCI China 1.3%. We are now on day 6 of losses on the CSI 300, which would take this losing streak onshore on this specific index to the longest streak going back to August of last year. We do have the inflation numbers. Oh, man, that's a really bad number.
Yeah,
okay.
0.1% for CPI.
What inflation?
So we're back to seeing prices actually heading down south. We're still waiting for the PPI number. But yes, so after that brief sort of blip, I guess you could call February now, on the back of course, Lunar New Year, we are seeing CPI prices pretty much close to zero now. And there you go, PPI prices, yes, another month of contraction. We're down 2.8%, and that marks the 18th straight month of deflation.
Yeah, just a little bit of more context on the CPI print, Yvonne. So at 0.1%, that came in at the lowest end of forecast. So the range was 0.1 to 0.8%. That came in just barely above zero. So effectively, no inflation. Do the math with where you are on your yields, bottom of your screens, and you get a sense really of where yield interest rates are at the moment. Dollar China seeing a little bit of strength coming through right now, 725.72 here against the U.S. dollar at this point.
Yeah, let's bring in our Asia economics correspondent, Katya Dmitrieva, to walk us through these numbers. What do you make of them?
Well, it's not good news for the economy in general. I think every economist you talk to will say that they're waiting for this exact number to start perking up just a little bit. I mean, industrial production and manufacturing growth is fine, but without consumption, without retail sales kind of perking up higher than where they have been, it's not really possible for China to have this sustainable growth, and that's why I think economists are calling the 5%, around 5% growth target for China quite optimistic because of numbers like this. And PPI is much the same because those are really representing the price pressures, or in this case, deflation that might be coming through the pipeline into consumer prices. So it's not looking great on that end, at least.
On the growth end, though, we're getting some Wall Street banks coming on and just notching up some of their earlier projections on growth here.
Yes, that's right. So we had Goldman overnight, interestingly, right after Fitch downgraded its outlook. But you have Goldman that came out and said, no, we see stronger industrial production, we see stronger manufacturing, and that's enough. That's good enough to sort of upgrade where we think the economy is going to be to the 5% mark, which is exactly where the government wants it. Looking through some notes earlier this morning, I know Citi had upgraded earlier this month as well their year-on-year outlook. As well as other banks kind of taking a look. And that's really on the back of all the PMIs we've been seeing, the really strong PMIs in China the first 2 months.
What does that mean when it comes to policy? Do you think, there's a weak inflation print, but then you also have more solid macro data as well? Does that mean that we're still going to be in wait-and-see mode when it comes to what policymakers might want to do?
Yeah, I think that's right. I mean, you have very strong investment from the government, which is interestingly, ironically, maybe exactly why Fitch downgraded where it sees the economy, or rather where it sees debt levels. So Fitch is really concerned with debt, and that's exactly what the government's going to be doing. It's part of this growth story. We know the government's trying to pivot away from being so reliant on real estate. And to do that, it needs to invest heavily, which means more debt. At the same time, that's exactly why economists are actually quite confident in the economy, because all this provincial debt, all this local debt, it's implicitly guaranteed by the central bank, by the central government. So in some ways, economists actually see that as a positive rather than a negative.
There we go. Katya, thank you so much on the latest there on China. Katya Dmitrieva, our Asia economics correspondent. They're just taking us through inflation, some of the growth forecasts coming through. And just ahead, in about just 30 minutes from now, we'll be talking about these inflation numbers, which did just come through with Hang Seng Bank. China, Dan Wang joins us, in fact, in our studios, normally based out of Shanghai. So she is gracing us with her presence this morning at those times on those screens. And we'll see what she thinks about growth and whether or not she's seen enough maybe to lift her growth forecast. I don't know. We'll ask her that question later on.
I think this is the first time we're meeting her in person, too.
Yeah.
Which is big for us. But yes, no, we're happy to have her here in the studio.
Nerds.
You take a look at how movers are doing here right now. Obviously, it's a tech space that's getting really pummeled here this morning. Yesterday, it was the EV sector that was the standout. You're still seeing that when it comes to stocks like Xpeng. But look at what Bilibili's doing, what NIO, Alibaba, seeing some sizable declines across the board here. We're still watching what goes on with gold, with oil. Obviously, oil continues to edge higher, just given some of these tensions that we're seeing in the Middle East as well. So we're taking a look at what is going on here. Yep. You're seeing a bit of divergence. So gold miners are taking a step back. Energy players still doing quite well here. PetroChina up about 0.5%. Plenty more ahead. This is Bloomberg.
Henry McVeigh, who's our CIO and head of macro, calls it a higher resting heart rate. Higher inflation for longer and higher interest rates for longer. So returns will naturally have to reflect that. Having said that, risk versus return is very much dependent on where you're investing. And, private credit is the safe end of the spectrum, and then you have your more risky private equity assets. We don't do venture capital.
All right, that was part of my conversation with the KKR head of APAC Institutional Sales and Family Capital, Kate Richdale, at Bloomberg's New Voices event in Hong Kong yesterday. We'll have more of that discussion later on in the show. Yeah, we'll somehow continue some of the conversations and the thoughts that were just brought up there. Yvonne, of course, had a very long day yesterday. It's amazing you're still here. Have you had any sleep? Still standing. I'm okay.
You've had
Don't worry
sleep,
about
right?
it. Yeah,
okay.
We'll be fine.
We did have a good
Thanks
breakfast.
for checking, though.
There we go. Matthew Michelini is with us here, partner and head of Asia Pacific at Apollo Global Management. Good morning. It's nice to see you here.
Thanks for having me back.
So I'm not sure if you heard one of the comments coming through, but I'll just recap it. KKR, they're sticking, speaking of private credit, they're sticking to the top high quality, the top end of the capital structure still. I know you guys are big on that as well, high quality. Or are you tempted now, given all the players coming in, given the yields on offer, to start looking down the capital structure?
Well, thanks for having us. And
sorry to go directly into it, but yeah.
No problem. For private credit, by and large, we manage about $450 billion of credit as it is. We're the largest alternative credit provider. We chose to focus our platform on senior credit.
Okay.
The way that we've done that is we've invested about $8 billion of our own capital buying origination platforms. So these are the businesses that banks used to own. These are the businesses regional banks used to be in. It's trade finance, it's aircraft leasing, it's lending to planes, trains, automobiles, consumers. And so we own now 16 of these that originate senior credit for us every single day. And so for the last 15 years, we've been building this business, and we're the largest. We also at Apollo provide senior capital to investment-grade companies. Yeah. So we did a multi-billion-dollar deal for AT&T. We did a multi-billion-dollar deal for ADNOC, a multi-billion-dollar deal for AB InBev. And that's because they were looking for capital that the banks are no longer providing. And it's not plain vanilla where the markets easily digest it. That's right. They needed something tailored and bespoke, and so we were able to step up with our capital and provide that.
What are you seeing in terms of demand in the private credit space right now? I mean, it seems like institutional funding has at least dried up a bit. Are wealthy investors, are they kind of stepping into that role in some way?
Look, there's significant demand by companies and consumers for private credit, again, because the banks have really pulled back, especially in the U.S. And the regional bank business model is still in question of what it's going to be over the course of the next several years. And so private capital is stepping into that. From an investor perspective, absolutely. I mean, there's a once-in-a-generation shift from equity value to credit. And in private credit, when you can earn top of the capital structure 12, 13%, and then investment grade mid to high single digits, those look like pretty good yields when you compare that to what long-term equity returns have been. And so that's why our investment strategy has been on senior credit and also on hybrid, which is senior equity.
Geographic focus this year for you would be which bits? Like what are you guys busy with right now?
So our business has been very active in the U.S. and Europe. Deal activity for the whole sector has been down in Asia, given that the relative value of what the U.S. has offered has been much better. Because the Fed raised rates 500 basis points.
Yeah.
Asia didn't need to.
Can't argue with that.
Asia didn't need to because the Asian central banks didn't print as much money. They didn't expand the balance sheet as much, so they didn't have to raise rates as much over the last 2 years to fight inflation. The U.S. did, and so that dichotomy has created a bit of a challenge in relative value. But you've seen deal activity pick up quite a bit across Asia. We've seen a lot of activity in India. We're seeing activity come back to life in Australia, and we're seing a lot of activity in Japan as well.
In terms of deals, I mean, are the deal sizes in Asia a little bit smaller now as well? And are you able to look for those investment grade opportunities out there?
There are large deals to do in Asia. So we just recently announced a big carve out from Panasonic, one of their big businesses that make cockpit systems for cars. A year and a half ago, we did a $750 million deal for the Mumbai airport. We do, but by and large, you do need to be. There are going to be smaller deal sizes in Asia because you have to be local. I mean, the big change in the Asian markets over the last 10 years is the local markets have gotten very sophisticated on the equity side and on the private credit side, filling in the gaps where the banks are not. And so you have to be local to be able to source those deals. If the deal is large, it's going to typically come to the big deal centers like Hong Kong or Singapore, or maybe even New York and London. But yes, the deal sizes will be smaller, but you'll also find some very large deals to do.
How small do you guys go? In other words, what would you leave to the others?
It depends on the risk reward. So at Apollo, we tend to do 100 million and up, but we do a lot of smaller deals through our platforms. So we own a stake in MaxCap, which is a real estate development lender down in Australia. Their average ticket size could be anywhere from 10 to 50 million. When we bought Credit Suisse's securitized products business, that came along with a great Australian business that Anthony Herman is now leading, and we'll do small deals out of that platform. And so through our platforms, we'll do smaller deals. At Apollo, we tend to stick to the slightly larger deals, 100 million and up here in Asia.
I want to take your take on China. Obviously, this is the China show, but are you looking at China as an attractive investment venue, or even just for capital raising right now?
Look, the headlines, if you look at the headlines, we always start with where the bank's trading. And the banks are trading at somewhere around 0.2, 0.3 times book. That's a good reflection of investor sentiment. Whether that's reality or not, it's a reflection of investor sentiment.
Right.
What that tells us is that obviously the property sector was 20% plus of the economy. It won't be 20% plus of the economy going forward. It was a big driver of the economy. But we do see a lot of green shoots in China. If you look at all of our private equity portfolio companies and hybrid value portfolio companies, we would be the size of Ford globally. And all of those businesses are doing very productive business in China today. We have about 10,000 employees through our portfolio companies in China, over $5 billion of revenue, and they're seeing great growth. They're seeing growth in auto supply, logistics, warehousing, so on and so forth. So there are really interesting things in China to be excited about. But the 0.2 times price to book in the property sector overhang it's going to take some time before sentiment turns around.
And how are you probing that demand right now? Is it through private wealth managers here in Hong Kong?
So we will execute deals through our hybrid strategy. So China obviously has a very robust banking system, and they have a very sophisticated equity system now, both domestic and foreign players. Our job is to provide the capital in the middle that isn't easily provided. But going to your question about our wealth business, we've absolutely seen demand from Asian investors generally who have been heavily allocated to real estate and domestic equities here in Asia, demanding credit, global credit. So we have a semi-liquid private credit vehicle that has done very well out here in Asia through our private bank channels. And when you can get top of the capital structure, again, low double-digit returns, that's a pretty good alternative when you're looking at the equity outlook here in Asia, or even where real estate prices are going.
Yeah, and also given the state of the equity market, that as well. When you look at your portfolio companies, just to get a sense of how the economy is doing, for example, or the greater economy, are you seeing any particular signs of repayment stress, or are things business as usual, for example?
Things are by and large business as usual for us, because in our private equity business, we've always had a purchase price matters mentality. We always buy good companies at 6 to 7 times EBITDA. That means we need to roll up our sleeves quite a bit to find good companies at those prices, but that's what we've been able to do for 35 years. And so as a result, we also lever these companies much less.
Right.
And so we don't feel this. I mean, of course, we feel the increase in cost of capital, but we feel it less than if you'd bought something for 20 times, levered it 10 times, and you were really hoping on low rates to preserve your terminal value multiple,
right,
and you were hoping that the cost of capital didn't go up in terms of the cash flow coverage for your debt. So, yes, we certainly feel a little bit of the cost of capital increase, but our purchase price matters discipline has really helped us.
How much has your cost of capital gone up the last, since the Fed started raising interest rates? And I'm wondering, has that affected really just your universe of possibilities at this point?
So on the equity side, specifically, it actually hasn't. So one of our biggest deployment years in private equity was last year, mostly because the financing markets weren't available for large deals. And so we were able to find creative ways to finance these buyouts and finance these transactions. Yeah. And then you take advantage of market opportunities like in January, February, where you had a record issuance of IG, record issuance of credit in the public markets, and you refinance into a lower cost of capital.
Can you talk us a little more about other geographies like India, Japan, obviously? I mean, there's so much hype about both these markets here right now. What benchmark metrics are you using to determine if these markets are going to deliver?
Yeah, so Mark, our CEO, has said that Japan is one of our most important markets outside of the U.S., and for really good reason. It's interesting. You look for the last 20 years, they've obviously been in deflation, or at least noflation. And if you're a consumer, the rational thing to do is to hold cash. So they've held 50 to 55% cash for the average consumer, 25% in domestic equities, and then 25% in other. But if you look over the last 20 years, that means that their portfolio has gone up only 1.2 times versus the average saver in Europe or the average saver in the US went up 2.5 times. But now you have inflation coming in, both domestic as well as imported. You also have something else that happened over the last 20 years. People got older. And so in the period where savers could have been allocated to beta, allocated to risk, that's when they should have done that. But now that they are ready to retire, failure is not really an option on the investment side. And so what they're looking for is they're looking for safe, guaranteed product that can generate alpha, generate excess return, because they're now facing inflation for the first time in 20 years. And the government needs this because you think about it, it's over 50% of Japan's GDP is consumer driven. But if you have a bunch of retirees who are worried about inflation and invested in cash, you're not going to get people spending. And so you've seen the government really focus on asset management reform to bring good high-quality investment products to the average Japanese saver. And we've announced partnerships with Nomura and Sumi Trust, and we have a very fast-growing business through our retirement services arm, Athene, in Japan.
Looks like you're going to be announcing some big moves, I imagine. Anyway, we'll see. That's speculation. Matt, it was great to see you. Thank you so much.
Thanks.
Matt Michelini there, partner, head of Asia Pacific at Apollo Global Management. We'll leave you with a look at the semi-sorry state of equity markets about 18 minutes into the session. CSI 300, thank you to our producers here, matching the longest losing streak since July of 2023. That's 6 days in a row. Plenty more ahead. This is Bloomberg.
All right, so we are hearing some news now when it comes to South Korea on the back of these parliamentary elections. The Prime Minister Han has offered to resign. That's according to Yonhap News, and this is according to Yoon's chief aide and senior secretaries have also offered to resign. So we have seen the Kospi. We're coming off some of the lows now, but certainly seeing some declines here on the back of this significant loss for President Yoon Suk-yeol in these elections. So that's probably why we are seeing that downside on the back of this stronger US CPI print. The yuan also is weaker. We're hovering on those 17-month lows right now. Yeah,
speaking of CPI, just to recap in case you missed the Chinese inflation report, which came out about 22 minutes now back, and really a discouraging number when you look at CPI, for example. So inflation itself, so consumer prices actually came in at the very low end of forecasts and missed just about every single one with the exception of that low one at 0.1%. How many months have we been in? 18 months in producer price deflation. They're negative 2.8%. Now, that is in somewhat of a contrast to the thinking around growth, and some of the banks have come through and revised their forecast on Chinese growth.
Yeah, Goldman came out. I mean, basically, Hui Shan thinks 5% growth for 2024 is their new projection here. So that's in line with, of course, the country's growth target. And she basically said recent macro data has been solid. So it suggests perhaps we saw that bottom in the economy in late 2023, and now things are looking on the way up. Morgan Stanley also upgrading theirs to 4.8%. So really, it seems like, you know, what we're seeing in exports and industrial profits, the like, and those things are certainly enough to really spur up those growth forecasts, despite what Fitch saying and putting a negative outlook there on the country.
Around the debt risk as well. Yeah. So yeah, the team this is Robin Shing, of course, at Morgan Stanley, just to add to Hui Shan's point from Goldman. It's a strong export volumes coming through. It's the strong manufacturing capex. So the bank now expects Q&Q growth to moderate an average below 4%, but on a year-on-year, they've ratcheted it up now to 4.8%. All right.
Yeah, we're looking at markets here right now. Obviously, it's a down drift across risk assets here today. We're watching property stocks in particular with China Wanka shares. There you go. We're down close to 3% after there was a downgrade from S&P on their rating to junk now. And that's really sending a lot of these property names lower here this morning. Link REITs down some 5%. That's more of a Fed story, I'm guessing, as well. You take a look at how some of these benchmarks are doing here as well. We talked about the longest losing streak we've seen in the CSI 300
since July of 2023, 6 days now.
Yeah, and basically we reversed all the gains that we saw in Hong Kong here. So we're back below that 17,000 level. I think your alpaca suit is still fine. You don't have to take it out of the box yet.
Not yet.
Just yet. Hint, hint.
If you guys need some reference, maybe you can scroll down my Twitter feed to find out
Inside joke.
that. Now, if you are feeling depressed, looking at these equity markets, look at the bond markets, and you'll feel a lot better about them yourself. So we're looking at just about almost, I would say, on the long end, Australia, New Zealand, Japan 10-year yields are up 6 basis points. We're now at 0.833. Double-digit gains right now as far in basis points, that is, here on Australia and New Zealand. So you do get a sense that the bond bleed is really where you are feeling this is the pain point of the session today. And by the way, we haven't even talked about the ECB. Rate decision later today. Some great guests coming up to talk to us all things economics and all things investment strategy. This is Bloomberg.
Welcome back to the China Show. Second hour. Here's a look at the CSI 300, a half hour into the session, and it's just marginal declines. But we're still on track for a 6th straight day of losses there in the onshore markets. But certainly, you look a little bit out, zoom out a little bit, and it's looking pretty ugly out there, Dave.
Yeah, well, ugly CPI print in the U.S. Really, markets rethinking not just the number of rate cuts. Maybe the possibility that we might get one to the upside out of the Fed might be, of course, in the extremes and end of that sort of projected spectrum. But it is certainly part of the conversation when you look at, we were talking about this earlier, right? If you're depressed about the equity markets, look at the bond markets and you're going to feel really good about really the losses we're seeing here. So we are coming off. So just to give you an example, right? The 2-year yield, nominal yield, biggest jump in about a year, biggest drop in about a year on 2-year futures. Treasuries as a whole are coming in. We're coming off the worst day on U.S. Treasury, second worst day in about 6 or 7 months or so, just to give you a sense. And, 5%, right? Who would have thought we'd be back at 5% and near that level on the 2-year yield? But that's we're a bad day away from that as well. Just to give you a sense as well, currency markets are more fairly mixed, more fairly balanced following what happened overnight. We're still paying attention, of course, to what's happening with the Japanese currency. At 152.83, we're off highs of the day. We were above 153 early on Thursday, about 4 a.m., 5 a.m. local time, if you're thinking Tokyo as well. Keep an eye on that. Of course, it's ECB day, so the ECB is going to be very much in focus on what they say and how they say it later today. Apart from that, of course, Yvonne, we're still digesting what's taking place across these markets, and we haven't even talked about Chinese CPI yet.
Yeah, we haven't, and it was still a bad print. So, but showing something very different than what the U.S. is dealing with right now as well. You talk about the yen. I mean, certainly we've heard from Kanda-san as well. If we see some sign, we briefly touched that 153 level. If we see anything more, we already seen signs of that verbal intervention here this morning. But are we seeing enough that volatility for Japan to step in? Let's bring in our MLI strategist, Mark Cranfield. He's with us right now out of Singapore. Mark, it's a bloodbath out there. What's top of mind for you today?
I love the way that David found something optimistic in a sea of red. I think that was great.
He's always a positive guy.
In a way that, but in a way that's actually right, because the equity markets will probably be able to absorb this a lot quicker and a lot easier than the bond markets will, because if you think about, particularly if you think what's driving U.S. equities especially, earnings are still very good. The economy is coming along very well, and they've been used to 5% interest rates for some time. They factored that in a while ago. There may be a little bit of disappointment that the Fed looks as though it will only cut rates much further down the road. But really, that's a marginal difference if you're an equity investor. Plus, you've got the European Central Bank coming up today. And who knows, maybe the European Central Bank is going to be the dove that saves everybody today. Traders are expecting a pretty dovish outlook from Christine Lagarde today. They're probably going to be lowering interest rates before the Fed even gets started. And we may actually see that European equities get a bit of a boost out of the message from ECB today, and it may filter through to the US a bit. So really, that's probably the biggest takeaway message from all of this, is that bonds are going to struggle for some time because that inflation print just knocked everybody offside. But equities can probably get over this a lot quicker than the bond market can.
Right, and we are entering earnings season in the U.S. Tomorrow you have the big banks reporting, and I'm wondering, to your point, Mark, and the point our other guest this time in the last hour, Bill Maldonado of Eastspring, said, don't look at the Fed, look at the economy. And I'm wondering whether earnings is able to somehow save this equity market and we can ignore inflation for now.
Well, certainly investors will be very reassured if they see that the major companies are still making very good profits and they have a positive outlook. That will certainly make them feel a lot more comfortable just because a CPI number was hotter than expected and Fed speakers are being a little bit more cautious on their outlook for interest rate cuts. In the end, earnings, cash flows, people seeing more business being generated, that's really what helps to drive the equity market. So yes, this earnings season in the US comes at just the right time, providing that most of the companies beat and the outlook is positive. It comes at a very good time in relation to what's happening in the fixed income market.
Right. Mark, speaking of fixed income, the JGB yields are up, I guess, following what's taking place in Treasury markets. How worried do we need to be about intervention from Japan while the Prime Minister is whining and dining, of course, with the U.S. President at the White House today, as we speak, I believe?
I would have thought that the Prime Minister being in the US will not dissuade the Japanese authorities. If they feel they need to defend the Japanese yen, I think they will go ahead and do that, regardless of where their Prime Minister happens to be. Our colleagues in Tokyo have built this model, the Kanda model, which he's the chief man for intervention from the Japanese point of view, and they say the model doesn't yet justify intervention from the Japanese authorities. It's getting closer, but it hasn't reached the extreme levels that we've seen in previous situations. October 22 was the last time when they did so. But we are certainly much closer than we were before the CPI print yesterday. So yes, we're moving into that territory. And of course, the Japanese authorities may feel that market traders here are getting themselves too long of US dollars already, and they may want to do something about it. They've had a lot more success outside Asian hours than they have inside. So it could well be they'll wait for London or probably New York trading time if they're going to do something. So really, FX traders need to be on alert on a 24-hour basis from here on.
I mean, I think most Asian currencies are at the mercy of what the Fed and what the dollar does here at the moment. And the renminbi certainly is part of that right now. I'm just wondering, what can policymakers do at this point beyond just that stronger fix that we saw today?
Yeah, I mean, as you say, there's not a lot they can do when dollar yields are moving the way they are. We were just writing about it on MLive. If you look at in the Chinese case, for example, in the 1 year forward points have just moved to the widest since 2008. So basically, the Chinese side have done nothing, but because dollar yields have gone higher, it's even cheaper to short the yuan against the US dollar than it was just a couple of weeks ago. The central bank in China, they may be trying to keep the fixing very tight. They're trying to reduce volatility in the spot rate between the dollar yuan. There's nothing they can do about US interest rates. So as long as they keep on going up, it makes it even cheaper for traders to short their currency. It's out of their hands. So in the end, as you can see with the Japanese yen, eventually central banks just have to allow the market to take over. They may try and modify it, which is quite reasonable. But you cannot fight. The US dollar is the biggest currency. It's got a lot of momentum. You cannot fight it indefinitely.
Right. So I guess to travelers right now at the airport headed to Japan, if you're thinking about doing it right now or when you arrive, do it when you arrive. Mark Cranfield in Singapore for us, our MLive strategist. And by the way, I didn't mention a location. It could be Beijing, Shanghai, or Tokyo. There we go. Speaking of China, speaking of growth, speaking of inflation, speaking of forecasts coming through Goldman Sachs, Morgan Stanley have changed their forecast on the Chinese economy. 5% in Goldman, 4.8% for Robin Shing's team at Morgan Stanley. This is how they look, and this is how the forecasts actually are coming from 4.8 from Goldman Sachs, 4.2 from Morgan Stanley. Right in between these two numbers is a 4.9 forecast from our next guest. Dan Wang is with us here on set, chief economist at Hang Seng Bank. China, 4.9%, upside risks to that figure?
Well, it's hard to be too optimistic at this point, especially with the ugly data coming out for Q1. And the 4.9 is towards the lower end of the government target range. And we think there's a chance that we might have to lower this forecast, given how difficult it is for a lot of projects to roll out in China right now.
Where is the inflation right now, I should say? With that inflation print, it seems like we're still not seeing any signs of domestic demand coming back in a big way.
Yeah, and if we're talking about goods market, there's really no sign of any prices going up. Maybe from the second quarter on, the pork price might tick up because the supply-demand starts to shift. The supply of the pigs are starting to decline from earlier this year. And then when it comes to the services prices, tourism, transportation, entertainment, they do have a tendency to go up in the first quarter. Especially we have a longer holiday season this time in April, and that has encourage a lot of people to get out and spend more money. And slightly, we see this kind of improvement in consumption. So that's one slight source of this small inflation. Yeah.
And you're normally based in Shanghai, and I'm wondering what the mindset of consumers are as it pertains to inflation. Are people thinking prices are going to fall? Because that's a bad mindset to get into for consumers. Well,
if you're living in China, people have this perception now that inflation is nowhere to be found. Probably it's going to be a permanent phenomenon that China will be stuck in this sort of low inflation environment. And a big reason for that is when you look at different industries, there's still a trade war going on in almost all the consumer goods sector. And the factory inflation has been going down and down for over a year now. For Chinese companies, they are under huge pressure to actually adjusting down their prices instead of adjusting up. And for Chinese consumers, they're still quite conservative about where the economy is going. With the housing market down, and people actually still have very high tendency to save up more.
So that brings me to this overcapacity conversation that's taking place. Janet Yellen was in China recently, and is there an overcapacity in Chinese industry right now?
From an economic perspective, you have to define overcapacity because at the right
inflation.
price, inflation, yeah. Exactly. So at the right price, you can basically sell anything. But before COVID started, China was going through this phase of overinvestment in the manufacturing industry. So it is true that across the board, it's not just only within those green industries like the emerging industries, new energy, new material, but also in traditional industries like cement, glass, you name it. Almost every single industrial sector is going through this overinvestment. And now we see a lot of idle capacity. Part of it was because there is a lack of demand for housing and construction. But the other part is really coming from this huge effort from the government to help China to gain more advantage in its green technology and green industry. So as a result, we do see this lack of momentum in the industry to curb back its investment in those industries. But I think the bottleneck still is in the demand side. So if the global market is still open to China, then we won't have a long-term overcapacity problem. But now it just seems that not just Americans, but also the Europeans start to be very concerned that China's cheap products, including the green products, will wipe out some of their industry.
And how do you think that's going to play out? Do you think that's just going to be more consolidation within the EV space? Are we starting to see signs of that right now in any way?
Within EV space, there are 77 OEMs in EV industry in China, and only about 20 to 30 of them are under this sort of normal utility usage range. So the rest of them will probably have to go through this really rapid consolidation phase. And the government support, although still very strong, there are signs that some of the subsidies still are a bit behind schedule because the government also needs to be sure that they can find a proper outlet for all those capacity. You can't just keep producing and put them in storage. And the domestic consumers, they have been the main driver for the EV market. But without further support from the government, I just don't see a real incentive for a lot of families to buy new cars.
And that goes back partly to the note coming out of Goldman and Morgan Stanley. The reason they've upgraded their forecast is because maybe that capacity is exported and that brings in growth. And I'm wondering if, when you look at the export picture, new export orders PMI came in at 51.3, somewhat high, for example. Do you think the export pillar will be able to support growth this year more than what we think right now?
I actually think export will be the main driver for China's growth this year. In the first 3 months, it already exceeded market expectation. And the highest growth, to many people's surprise, it was with the U.S. So since the trade war started around 2016, the China-U.S. trade, or more towards a third country trade. And for Chinese producers, they're trying to relocate some of the supply chains overseas, and we all see that. And over time, during the past 3 years especially, we see this deeper integration between China and Greater Asia. So the exports from China to Southeast Asian countries, to Latin American countries, are way faster and still accelerating. And I think that trend will actually help China's growth in exports. And the global market, especially in the U.S., it's doing better than a lot of people had thought. So the demand from the industries, demand from consumers are quite strong. And that will basically bolster the fundamental demand for China's exports.
Given that we're still seeing quite a bit of deflationary pressures, given how weak the currency is right now, I mean, are those two big handicaps on whether policymakers can actually ease more and unleash more stimulus?
Well, we don't believe that there will be any substantial stimulus in China this year. The main reason is still housing. There is an understanding now that the Chinese government has no intention to blow up this housing asset bubble again. And the main effort is to stabilize the local banks that are highly exposed to housing market and local government debt, and also to stabilize some of the regions that have huge pressure to see housing prices fall more. So we think what's going to happen is that the government will try their best to shore up their support for affordable housing program, low-cost rental housing program. But for the commercial housing market, we believe this year probably will be even more difficult than last year. At least in the first 2 months, the housing sales and housing prices have worse performance than last year overall.
Wow. Okay, Dan, thank you. Great to have you here in our Hong Kong studios. Dan Wang there, Chief Economist at Hang Seng Bank, China. Still ahead, we get Deutsche International Private Bank's view on markets under that hot inflation print in the U.S. and, of course, on this sell-off that we're seeing across the risk assets as well as when it comes to bond markets here in the region. This is just Bloomberg. Well, China's investability was a key topic as financial executives gathered for Bloomberg's New Voices Hong Kong launch event. I did speak with KKR and HSBC Asset Management, with both sounding quite optimistic.
So first of all, the context is that the global fund allocation to China hit 5-year low, right? So the room for further sell-off is significantly reduced, put it this way. And then I think the concerns of our investor where we talk to, primarily relating to geopolitical events like US election, the weak property market in China, the long-term growth of China and all that. So at the same time, the big discount, valuation discount, right, to the global markets and the Asian market versus China, also explaining why the underweight situation for so long, right? But as we talked about, right, we see the sentiment has improved because of, for example, the cyclical growth stabilization, and then we also see capex expansion, meaning that actually the market is already out of the deflationary cycle. So with that, we started to see some regional active manager cutting back their underweight position in Hong Kong and mainland China, and then add back to, for example, the tech or the growth stock starting in February. So this is what we have been seeing. Having said that, again, I think investor eventually they still need to see the earnings revision before we can see more sustainable, like big inflow to the market. So I believe this will need some time, right, before the key trends, right, like moving back to China.
Yeah, Kate, how attractive is China, this market, to you now? I mean, obviously you've been trying to tap into the wealth, and what's the way to capture that in China right now?
So we have invested in China. We continue to invest in China. We do think that China is investable. You know, if you talk about some of the trends that Daisy's highlighted, you know, China has come under pressure, obviously, in the real estate sector. But if you think about the new economy, the green economy, the industrial automation, this comprises about 20% of the GDP growth, but it's, you know, it's actually 50% of the growth. And so that sector is definitely of interest. Consumption upgrade, technology upgrade. So we're a simple investor. We invest in retail pharmacy chains. We invest in hospitals. We invest in white liquor. We invest in pet food, mushrooms. You know, it's the consumer that we are after. And if you think about 850 million odd of millennials, you know, these are the consumers that we invest into. Now, I do want to add that renminbi as a currency, when you look at trade, has an increased transaction, you know, volume today. We see the renminbi currency as an ecosystem in China, and we want to invest into that.
Daisy, you mentioned a little bit more about, you know, putting cash to work. What are clients telling you right now? I mean, obviously, equities have done quite well so far this year. It was supposed to be the year of the bond. We haven't quite seen that yet. And commodities are doing quite well as well, even the likes of Bitcoin. I mean, what are their preferences right now? What are the fund flows telling you?
So I think for us, because of the risk-off mindset of a lot of the retail clients, that's why we see a lot of assets being piling to cash on money market fund, like I said, right? So I'm trying to generalize some of the investment behavior here, where in Asia, there's one secular theme, which is income. People here, they love income product, right, with dividend payout, with regular dividend payout. So I think this is the one trend that we have been seeing in different market cycles. And then, as I mentioned earlier on, I think for those who want to have higher return, seeking higher return, they would be going to equities, going back to equities, and then India. I think India is a very obvious choice for some of the investor, not even on the equity side, even on the fixed income side. When you look at India, because of the JP Morgan, the bond index inclusion of India government bond, right? So only after announcement until March, we have already seen around 8.8 billion into the local Indian bond market. So you can see, right, the potential there. And then we have large institutional clients already looking into allocating to India fixed income as part of their allocation. And I think over time, these large institutional clients, they would definitely look into beyond just because of the index inclusion, right? They will put it as a strategic asset allocation. So we envisage, we envisage the fact that for India, for example, the fixed income market, we will see, for example, in the next 3 to 5 years, 100 billions of investment getting into India for the market. And of course, right, you guys can see in the stock market where it has been performing very well. And I think the story will continue. So that is a very, very strong inflow as part of the investment theme over the past 12 months.
That was my conversation with HSBC Asset Management's Daisy Ho and KKR's Kate Richdale. And Bloomberg New Voices is an initiative focused on amplifying the views of women and underrepresented voices in business and finance. And you can find more information from that launch event on the terminal and online. Plenty more ahead. This is Bloomberg.
One particular part of this market that's really moving against the grain is oil. Oil prices continuing to move higher. Shanghai crude, as you can see, and against the backdrop of equity markets falling, that sector in the Asia Pacific is up. just on the back of what we're hearing from sources from U.S. sources, that a strike on Israel from Iran might be imminent. Watch that space very, very closely. Ahead of that, we are going into the Japanese lunch break, cash market that is, but we'll continue to track anything that goes on in the currency markets, especially where we are at this point. This is Bloomberg.
11:29 a.m. in Tokyo. Japanese markets heading to that lunch break, and oof, they probably do need a bit of a break here right now. Take a look at how that dollar-yen trade is looking here. I mean, after we briefly touched that 153 level, we're just slightly off that here right now. So we're seeing a little bit more strength come through, but certainly the last couple of hours, it's been the lines that we saw from the the FX diplomat, as you could call him, Okanda-san, just talking about what it means for intervention and whether they're not, at this point, excessive, of course, moves are bad for the economy. But, at this point, they're prepared to address any event.
Still on the diplomatic side,
yes.
I think markets will start rushing to the door when that language and tone starts becoming undiplomatic. All that being said, 84 basis points right now on the 10-year yield, so that takes you back to the highest levels of the year. The broad read across these markets right now, Asia ex-Japan down about 0.6%. Every sector is down with the exception of energy. It's ECB day, euro dollar, as you can see on your screens, 107.46, which just takes us to the question of the day, just to plug that. At what point do we get to a point where we see parity here on both currencies? Dollar China, bottom of your screens, we are just getting some lines coming through here from traders that Chinese state banks, speaking of maybe some relieving of the pressure here, selling dollars above 723.50. There we go. Maybe more a different form of intervention, if you will, here. So we'll just leave that there for now, but as you can see, it's still very much risk-off in bond markets, in stock markets as well. Let's hear from some of our guests in the last couple of hours talking about that hot inflation print out of the United States.
Inflation is just becoming a very stubborn situation for the Fed.
This is too much for the Fed.
Inflation's not doing what they wanted on average, and this is a problem for them.
The sound that you heard there was the door slamming on a June rate cut. That's gone.
I do think it shuts the door on a June rate cut.
The Fed is not, in our opinion, is not going to be making any moves anytime soon.
They're more likely to hold status quo.
Pretty good reason for them to remain on hold here, see how things go.
A rate cut in June, it seems to me, would be a dangerous and egregious error.
At the moment, I think they'd probably set up for September and December, 2 rate cuts this year.
There's a real risk of no rate cuts. That's starting to come into the narrative, and I think that's new.
They're, creating a problem for themselves in terms of the promises of rate cuts, the inability to actually execute on them.
Let's bring in Stefanie Holtze-Jen now, APEC CIO at Deutsche Private Bank. She joins us here. She's in town from Singapore. It's good to see you here in Hong Kong, Stefanie. You've been calling this for a while now, that some disinflation in the U.S. seems to be taking much longer and stalling. It seems like the market's kind of catching up to you in the reality.
Yes, but every time I come, I look like I'm a consensus person, and that's not the case. So I just quickly want to reiterate, last year, we were the only firm talking about no rate cuts last year. We entered this year with our yearly outlook when everyone was pricing 7 rate cuts, saying there will be only 3. And then we've just had our quarterly CIO day, and we actually took one of these rate cuts out into next year, first quarter, and are now at 2 cuts for this year. And now the market is repricing to exactly that.
Okay, and now that reality has moved closer to your initial projection,
yes.
What do you think the next few months looks like in terms of where you think your assumptions might go?
Yeah, well, I think a big part of the debate is right now about the timing. So we've been looking at, and this has actually been the reason why we've taken one of the cuts into next year. We thought we may not want to be cut too close to election time in terms of timing. So the market seems to assume June would be too early to start, and now pushing it back closer to election time. So we'll see whether, that timing debate, I think that's the biggest one that is injecting volatility right now, where that ends. Because I think maybe nothing wrong with starting to cut and then not just follow through, because that's the market is used to, starting a rate cut cycle with the consecutive cuts all the time. Maybe the ability to start cutting, because the Fed has put in a very strong pivot to start cutting, and then maybe leave some room before the next cut could be also a possibility.
What does this mean for risk assets? I mean, we just had Bill Maldonado on from Eastspring and saying that, if you don't focus on the Fed, you focus on fundamentals, and this is still a very resilient economy, and that can maybe still lead to risk assets to go higher. Is that the sort of narrative that you're still tracking here, or do you think that there's still a need to be defensive right now?
Well, so far we've seen risk assets holding on quite well, despite the constant repricing, and that was quite dramatic from the beginning of the year until now, where we were talking about 7 cuts. The narrative was trying to interpret that this is why risk assets and U.S. equities are able to climb higher, and yet we have repriced to such an extent, and we're still where we are. So I think, as you said, the narrative is now to focus on a fairly strong economic backdrop that can drive risk assets, and that I think is a valid approach to take. I think when you look at risk assets in the emerging markets, most probably tactically, once the rate cut cycle starts, for sure, and the market sees it coming, that's also something that can get more momentum.
Right. It's been more difficult to time things in the bond markets. Equity markets, I think you have this strong economy that you can lean on. What do you think? What do you do now with this Treasury market at 4.5% to 5% duration?
It's actually a level clients have been waiting for. So we'll see what the flow dynamic will be around this level, because it's difficult to start pricing in even more. I know there's been commentary that there may even be a rate hike. I think that is a bit too enthusiastic, because
even for you,
the disinflation trend has, it has started. Inflation has turned the other way. It's just not coming in as fast, and there's still risk around the outlook. So you have to digest data as it comes along, and that's a prudent way of digesting these news. But I wouldn't go to the other extreme now. And kind of, hope for even more to be priced in. I think this level is fair.
You mentioned about people are looking to go into this bond market. Is 5% yields, is that sort of that cap then that we could see in this Treasury market then?
It depends. I think right now is already an interesting level to go in from the feedback that I got from our client base.
Well, 5%. We're 5.5% on cash, and cash again is, this time last year people were going into cash, and the stock market was cheaper last year.
Yes.
And now we're back to the same levels on cash, and the stock market is more expensive. Tell me it's a bad idea.
No,
to put into cash.
And cash is an attractive value proposition, but as you go along expecting rate cuts to come, ultimately, that's deposit base will have to shrink and look at opportunities. And there's very valid rationales around why some of the markets are higher. You talk about the US being driven by technology advances that other markets cannot offer possibly. You look at the region, Japan having their own structural story plus a cyclical one on the yen. You look at India, very long-term, decade-long possibly infrastructure and structural story that will carry along. So I think there's very valid reason to see this higher, not just look at valuations, but at the real macroeconomic data that we're pointing out and macroeconomics behind it.
But if the dollar stays this strong as it is now, I mean, is that going to have such a drag on EM for one thing? And it's in particular some of these currencies like the yen and like the renminbi that are really being dragged down and maybe weighing on sentiment in these equity markets as well now.
It has been a drag for a while, I think. So we're getting used to this kind of setup, especially against the yen. I think it is a driver that makes it difficult. Obviously, as the government officials or the Ministry of Finance have been informing us, they really don't appreciate that the yen dynamic is just gaining more momentum as we continue to reprice and the US dollar strengthen, and this rate differential is kind of still in place. But it's a double-edged sword as well, because you have weak currencies. In the case of Japan, you have an export-led economy. These are cyclical drivers that are also behind, a very exciting equities market story. So to really turn it the other way is very difficult. So for some of these markets, that dynamic works. For others, maybe a bit more difficult. And I think we have seen some central banks not cutting rates, although in the emerging market space, although they would have the room in terms of the inflation picture, because they wait for the Fed to go first and not to have this negative dynamic on the currency.
What other message do you want to leave investors with as we look at the second that we haven't already touched on as well?
We keep on talking about equities, we keep on talking of bonds, very important in terms of portfolio construction. We very strongly feel you find growth in both and valid value propositions in both. But in terms of what a portfolio should also comprise is gold. And we've been early on talking about industrial metals, industrial commodities, and all of this is rallying right now as well.
Why do you think gold is at a record high?
Yeah, so gold is, and again, I want to go back quickly to the beginning of the year when we were out there with an outlook talking about 2,250, people looking at me a little bit bemused. And now, again, we've just upped the forecast to 2,400, right, which now looks very conservative because it's where everybody is now trying to picture it. We have the usual drivers on gold. I will not regurgitate on this, but central bank diversification is still very strong. And I think for this year in particular, I think it's the Chinese retail demand that's also driving it. And I think you see it in terms of data validation. You see it on two ends. You see the ETF volume spiking up. And when you look at premiums being paid locally for gold, these are also up. So we monitor this. And I think this is in a setup where you have, and we got inflation data this morning, you have a deflationary environment still. You have possibly a currency that doesn't offer a store of value at this moment in time as much. Yeah. You have still a property market that doesn't give you the same confidence like a US consumer that can still purchase because it has a good property value in the back of the pad. That is where you find store of value. So I do not think this trend to go away for this year.
5 seconds. What's the target on gold now? What are we going to?
2,400.
2,400
is our
new one.
target.
Okay, sorry, I missed that. There we go. Bemusing. Who's bemused now? Stefanie Holtze-Jen, thank you so much. APAC CIO, Deutsche Private Bank. In fact, you can find more on that conversation we just had and what's going on in the markets. Our Markets Live blog, MLIV Go. Rundown, one-click commentary analysis from our expert editors. You can also find out what's affecting your investments right now. Plus, later on in the show, we'll be talking about that particular angle to gold, the demand coming through out of the Chinese consumer. Plenty more ahead. You're watching The China Show. Welcome back. Here's your China brief of today. Here, look at stories making headlines in Chinese media. The China Securities Journal is reporting that ETFs tracking gold and related stocks are attracting retail investors. Now, it says analysts expect gold prices to rally even further, with the PBOC also continuing its purchases. The central bank bought gold for its reserves for a 17th straight month. That's in March. Now, the Economic Information Daily says several Chinese cities have eased rules for their residential property markets. And according to that report, 15 cities, including Guangzhou, removed the lower limit for mortgage rates on first home purchases. That's as of Wednesday.
Now, meanwhile, the Global Times is wading into these tensions in the South China Sea with today's newspaper spread. You can see it here, and the article includes views from Filipino analysts and ordinary people to support its argument against growing U.S. influence and military presence in the Philippines. And basically, you can see it in the big text there, quote, "Stop meddling." Now, Philippine government actions are causing unease among its ASEAN neighbors as well. The paper is also critical of the U.S.-Japan-Philippines alliance ahead of their leaders' summit in Washington. It says that behind their pursuit of cooperation, peace and security is a, quote, undercurrent of confrontation, danger, and conflict. Some harsh words there, Dave.
Yeah, ahead of that Trilat summit, which I believe is scheduled for 4 p.m. Eastern Time Thursday. So that takes place early morning Friday, if my math and my brain is still working. Let's bring in our Manila Bureau Chief, Manny Serapio. He's with us right now to talk us through. Manny, let's start with just the general expectations that you guys have, particularly the view in Manila, ahead of this meeting in Washington.
I think the tensions with China would be at the center of this first ever trilateral summit between the Philippines, US and Japan. And as President Marcos said yesterday before he flew out of Manila, he said that he expects there to be an agreement on keeping the peace and stability and freedom of navigation in the South China Sea. And obviously these comments are coming shortly because of the recent clashes between Philippines and Chinese ships in the disputed waters, which obviously because of the videos that we've seen show that Chinese ships have been deploying water cannons on Philippine boats.
So what does this then mean for, I think, the Philippines in terms of their assertions in the South China Sea? In other words, what does President Bongbong Marcos then hopefully come home with as far as that initiative or that exercise is concerned, Ben?
Firstly, I think it strengthens the partnerships that President Marcos is trying to build with its allies and like-minded nations to strengthen its posture in the South China Sea. And it aligns with the goal of the U.S. and China, which is keeping peace and stability in the Indo-Pacific region. And Marcos has been trying to rally allies. It's obviously its long-term ally, the U.S., but besides the U.S., there's also Japan, Australia, the U.K., in terms of for the world to recognize the rules-based order in the South China Sea. As you know, there are other claimants to the South China Sea in terms of the structures there, but China has not really recognized these claims and continues to make sweeping claims in this very vital waterway.
And Manny, just a final question. Apart from security of the seas, do we expect any other areas of cooperation between the three nations, of course, in this meeting coming up?
I think that there should be agreement and discussions in terms of boosting economic ties between them, in terms of critical infrastructure, in semiconductors, in renewable energy, and critical minerals, because the Philippines has been trying to partner with countries, with companies, to boost processing of its resources, mainly nickel.
Manny, thank you so much, Manny Serapio. There, our Manila Bureau Chief, joining us with what to expect out of this TriLab meeting. And of course, ahead of that meeting, President Biden's been hosting a state dinner at the White House for Japanese Prime Minister Fumio Kishida as they seek to boost security and economic ties. And the guest list, yeah, it was pretty good, right? You talk about Apple CEO Tim Cook, Amazon founder Jeff Bezos, JP Morgan boss Jamie Dimon. The two leaders earlier announced efforts to improve collaboration in tech and AI.
Yeah, meanwhile, the U.S. Justice Department has reportedly opened this antitrust investigation, and this is the big one, of course, Nippon Steel's takeover of U.S. Steel, Politico citing two people with direct knowledge of the matter, as far as that's concerned. Now, earlier on, President Biden repeating his support for U.S. workers opposed to that deal, $14 billion bids. But speaking alongside Kishida, Biden stopped short of repeating his call for continued domestic ownership. We heard from both leaders earlier.
I hope U.S. Steel acquisitions discussions will unfold in directions that would be positive for both sides. Japan believes that appropriate procedures based on law is being implemented. We are the largest investor to the United States.
I stand by my commitment to American workers. I give a man of my word. I'm going to keep it.
Meanwhile, we're tracking another meeting that's going on or has already gone on. Chinese President Xi Jinping has met with the former Taiwan President Ma Ying-jeou in Beijing in a rare act of diplomatic engagement between the two sides. For more, let's bring in our chief North Asia correspondent, Stephen Ingles. I mean, this was 9 years ago they had that meeting in Singapore and had that famous handshake.
Yeah.
How important is this meeting?
Well, it's more symbolic than actually an indication of any kind of thaw or change across the strait. No doubt. He is the former president, and they're the opposition, the KMT, and the DPP has now won 3 consecutive presidential elections. We were there in January. But I think that there is maybe a view in Beijing, and that's why they have not taken a very strident approach. They have not done any war games or done some economic coercion, as it's been alleged in the past, since the election of Lai Ching-te in January. Maybe they're waiting to next month in the inauguration. But again, keep in mind that, and we were there, Yvonne, at the election, you had a 3-horse race, and the 2 opposition candidates, if they had joined forces, would likely have beaten Lai Ching-te. Lai Ching-te got 40%, Ke Wen-je and Hou You-yi got a combined 60%. So that tells you that there's maybe an in for the views of more engagement across the strait, as Ke Wen-je and Hou Yu-ih wanted. And keep in mind as well, Ma Ying-jeou was sort of the power broker to try and get those opposition candidates in Taiwan to join forces. It failed, unraveled. So now he's here in Beijing talking to Xi Jinping. They're smiley, they're friendly, they're shaking hands, and they're talking about a more of a unified greater China, right? They share culture, they share history, they need to avoid war. So it's highly symbolic.
Yeah, well, I was about to say next month is the inauguration, of course, of President Lai Ching-te. And should we read into this as China changing its approach, mainland China changing its approach? Is this soft power from Xi, or do we expect the pressure to continue from Beijing ahead of the inauguration?
Well, the pressure has always been there, whether it's overt or behind the scenes. Keep in mind, on the day, essentially, that Lai Ching-te became the president-elect, Beijing was able to get another Pacific island, Nauru, to commit to Beijing, to switch diplomatic allegiances. Since Ma Ying-jeou left office in Taipei in 2016, 10 nations have switched allegiance to Beijing, including 5 Central American countries, 3 in the Pacific. Kiribati was another one, Nauru, and Solomon Islands, 2 in Africa. So that diplomatic pressure has been ongoing and will continue. There's another dozen or so that still recognize Taipei. Economic pressure will be consistent. The big question is between now and the May 20th inauguration, will there be any military provocation or pressure? That is yet to be seen.
Steve, thank you. Stephen Engel, our Chief North Asia correspondent there. Right, plenty more ahead here in shows. We'll get to you a recap of these markets. So we're coming off lows a little bit, so we're looking at slightly better footing, question mark. Strong dollar still, though. This is Bloomberg. Right, welcome back. So we're looking at, well, this is really one area of the market we don't normally look at, but, you know, given the moves globally, given the moves you're seeing in this specific pocket of this equity market, so these are environment-linked equities and plays in China, and as you can see from some of these names, if it hasn't get that away just yet, there's this low-carbon support plan that I guess in some ways traders are latching on to, at least for today, so we'll see how long this lasts. The broader read across these markets, though, we are coming off, by the way, a very strong session yesterday on MCI China. We're giving back, I wouldn't say all, but most of that as we speak, 55.93 right now. That's a look at how this session has so far panned out. Gap lower, and then we've recovered about halfway through. Global macro movers, equity markets are in offer post US CPI. The dollar's more, currency markets are slightly more balanced at this point in time, but it's really in the bond markets where you're really feeling the pinch. So if there was, I guess, a visual iteration of what it might look like if you pull your nose hair out, look at the bond markets.
I was going to say bleeding, but yeah, that causes that too. Yeah. But yes, no, it's painful across these sovereign bond markets here right now. Commodities, though, you're still seeing a slight bit when it comes to oil, but nonetheless, risk off. This is Bloomberg.